All right, so let's say you're looking to up your investing game, right? And you've picked up The Most Important Thing by Howard Marks.
Yeah,
Smart choice. Especially if you're after like a clear and concise breakdown of investing.
absolutely.
This book really digs deep into market psychology. It gives you this framework for making smart decisions.
So in this deep dive, we're going to pull out the key takeaways, especially if you're someone who wants to avoid those classic investing pitfalls and make some smart money moves.
One of the things that's so great about Marx is he doesn't promise any of those get-rich-quick schemes. It's refreshing. He
Hmm.
focuses on these timeless principles. He wants investors to really think critically. He wants them to understand what actually drives market movements, especially because beating the market consistently, it's incredibly rare.
It is. It's really hard. So how can someone even beat the market if it's that difficult? That's where this idea of second level thinking comes in. Most people, they see a company doing well, they glance at the trends, they just dive in head first thinking, okay, this is it, I got to buy now. But second-level thinkers, they take a step back. They think about what everyone else is already thinking. They ask themselves, is the crowd overvaluing this company? Is the current price already factoring in all the good news? So for example, let's say everyone is super hyped about a new electric car company, right?
Uh-huh.
A second-level thinker would look past that hype. They'd analyze things like competition, battery tech, even government regulations that others might completely miss.
That makes total sense.
Yeah.
So how do we avoid falling into those traps?
Marx uses a great example to illustrate this. Remember the dot-com bubble?
Yeah.
Yahoo, back in January of 2000, it was trading at a whopping $237 a share. Just a few months later, in April, it crashed down to $11.
Oh.
That just shows you how irrational the market can be. Chasing those hot trends without understanding the real value, it's basically financial roulette.
Yeah, that Yahoo example that's a wake-up call for sure. Prices can be really deceiving. Speaking of price, how do we even figure out the true value of something?
Marx emphasizes this really important distinction, value versus price. Price is what you pay on the market. It's influenced by all those emotions, short-term trends. Value, though, that's the intrinsic worth of a company. It's determined by looking at its fundamentals, earnings, assets management quality, potential for growth. Imagine a company makes amazing products, high quality, but they're struggling, maybe because of supply chain issues, something temporary. The market might undervalue them because of that short-term problem, right?
Makes sense.
But a smart investor, they understand the company's fundamentals. They see that as a chance to buy at a discount.
It's like being a financial detective looking for clues instead of just following the hype.
Exactly. And that leads us to another point Marx really drives home. Risk is always present. It doesn't disappear when the market's doing well.
Right. He uses that analogy of buying a house in California. Right. You might not even know about a fault line underneath
That's a perfect analogy.
until an earthquake hits, and then it's too late.
Exactly. During those good times, it's easy to think risk has vanished. But like that hidden fault line, it's lurking beneath the surface, ready to shake things up. Ignoring this can lead to some serious financial damage when the market eventually takes a downturn, and it always does.
So how do we avoid those earthquakes? Or at least, how do we prepare for when they hit?
Understanding market cycles is a big part of that. Marx argues that markets are inherently cyclical. They go through these periods of ups and downs, driven by, you guessed it, human emotions, fear and greed.
So can you give me an example of what one of those cycles might look like?
Sure, take the credit cycle, for example. When lenders are feeling optimistic, they give out loans easily, even to riskier borrowers. This fuels economic growth, pushes asset prices higher, but eventually those risky loans start to default. Fear sets in, lenders tighten up credit, leads to a slowdown and a drop in asset prices. Understanding this cycle can help you anticipate those potential risks and even spot opportunities, even when everyone else is caught up in the frenzy.
So those market crashes, are you saying those could actually be a good thing?
In a way, yeah. When fear takes over, people panic. They sell assets, often below their real value, just to get their money out quickly. If you've done your homework, you understand what something is truly worth. These moments of panic, they can be amazing buying opportunities.
So it's like finding a hidden gem in a bargain bin.
Exactly. It's about recognizing when the market is being driven by irrational exuberance or by excessive fear and then acting accordingly. It definitely takes careful analysis and a good understanding of your own personal risk tolerance. But the rewards can be significant.
Yeah, that makes sense.
You know, it's interesting. When you really think about it, this book isn't just about picking stocks or timing the market perfectly. It's more about developing the right mindset, like a way of thinking about risk and opportunity. That can help you throughout your whole financial life.
Yeah, you mentioned risk a couple times. How do we even wrap our heads around the idea that risk is always there in investing?
That's why understanding these market cycles is so important. Remember, they're fueled by human emotions. Greed, fear, hope, despair, all those emotions can cause these huge swings in prices, sometimes pushing them way above or even way below their actual value.
Okay, so if these cycles are basically unavoidable, can we just ride the waves, buy low, sell high? Isn't that the whole point?
It sounds good in theory, sure, but it's really hard to pull off in reality. Remember, we were just talking about how tough it is to predict those peaks and valleys. Even the pros get it wrong all the time.
Right, so what's the alternative? Do we just avoid the market entirely,
Okay.
wait for the perfect moment?
Not necessarily. Mark suggests a smarter strategy, being prepared for a whole range of outcomes. He calls it a combination of offensive and defensive tactics.
Okay, I like that, offense and defense. So what does that actually look like in real life?
Let's start with offense. This could mean looking for assets that are undervalued, maybe in sectors that are kind of out of favor right now. You're basically betting that the market will eventually recognize the true value.
Right, and that's where that second level thinking we talked about comes in.
Exactly. You're trying to find those spots where the majority is mispricing stuff, where there's a gap between how people see something and what it's actually worth. It's like finding a hidden gem in a market full of overpriced junk. It can be risky for sure, but it also has the potential for big rewards.
High risk, high reward.
Right.
Okay, so offense is about spotting those hidden opportunities. What about defense? How do we protect ourselves?
Defensive strategy is all about safeguarding your capital. It could involve investing in more stable assets, diversifying your portfolio, or even just holding cash during those super volatile times. Think of it like a strong defense in football. You need to absorb those hits, protect your end zone.
So finding the right balance between offense and defense, that's key to a winning strategy.
Absolutely. There's no one-size-fits-all approach. The perfect mix depends on you. Your risk tolerance, your goals, your time horizon. Are you investing for retirement decades from now? Or are you saving for a down payment on a house in the next few years? Your strategy will look different depending on that.
And I imagine knowing your own emotional tendencies plays a role too.
Definitely. Mark spends a lot of time in the book talking about those psychological traps that can trip up even the smartest investors. Greed, fear, envy, the herd mentality.
Okay, so how do we avoid falling into those emotional traps? It's easy to say don't be emotional, but it's way harder to actually do it, especially when it's your own money on the line.
Oh, for sure. It takes constant self-reflection and a good amount of discipline. You gotta be really aware of your own biases, those emotional triggers that can mess with your decision making. Like, ask yourself, am I buying this stock because I actually believe in this company? Or am I just trying to keep up with my friends who are making money?
Right, like it's almost like having a financial therapist on speed dial, someone to keep you rational when things go haywire.
That's a great analogy, having someone you can trust
Mm.
to challenge you,
Mm.
to help you see things objectively. But
Mhm.
that can be incredibly valuable, especially when the market is all over the place.
And even with the best plan, the most level-headed approach, luck still plays a part, right?
So it's an important point. Marx is very honest about this. We can't control every single outcome. There will always be unexpected events, things we can't plan for.
So it sounds like the key is to manage risk intelligently
Yeah.
and be okay with things not always going perfectly.
Exactly. Don't obsess over those day-to-day market fluctuations. Focus on building a portfolio that can ride out those storms. Achieve your goals over the long term. Remember, it's a marathon, not a sprint.
Thinking back to the start of our deep dive, Mark's emphasis on thinking for yourself really sticks out to me. It's easy to just follow the crowd, especially with something as complicated as investing.
That's so true. He reminds us over and over that the market isn't always rational, that crowd psychology can create opportunities for those who think differently. Like that saying, if you want to go somewhere you've never been, you got to do something you've never done.
And that's the power of this book, right? It's
Yeah.
not a rule book or some get-rich-quick scheme. It gives you the tools to develop your own investment philosophy,
Mm.
one that fits your values and your situation. It helps you become your own financial advocate.
Absolutely. And that's what makes it so timeless. It's not about chasing fads or timing the market perfectly. It's about having a solid foundation that can handle those ups and downs. If you have that foundation, you're better prepared.
You can navigate the complexities and come out ahead.
Exactly.
It's about having the confidence to make those smart choices, even when it feels like everyone else is doing the opposite.
Yeah. Having that framework, one that can stand the test of time, that's essential for making good decisions, no matter what's happening in the market.
Okay, so we've covered a ton in our deep dive into the most important thing.
Yeah, we have.
What really sticks out to you?
One thing that resonates with me is Marx's emphasis on humility, especially when it comes to investing. We can do all this research, build these complex strategies, but we just can't control everything, right? There's always going to be risk, chance, those curveballs, things that can totally impact the outcome.
He's definitely pushing for a realistic approach, recognizing our limitations, but still aiming to make the best decisions possible with the info we have.
Right, and that ties back to that second level thinking idea. It's not enough to just follow the crowd or get caught up in the latest trends. You got to think critically, understand what's really driving things, and be ready to go against the grain, especially when you see an opportunity that others might be missing.
That takes guts, though, right?
Yeah.
To trust your own judgment, especially when it feels like everyone else is doing the exact opposite.
Oh, it does. But Marx gives us that framework for building that courage. Do your research, understand value versus price, recognize those market cycles, and manage risk wisely.
Yeah.
When you have those basics down, you're way more equipped to make your own calls, even when they feel a little uncomfortable.
So for our listener, taking all this in, what's the one piece of advice they should really remember?
If I had to choose just one takeaway, it'd be this. Build a solid investment philosophy, one that reflects your values, your risk tolerance, your goals. Don't try to be someone you're not. Don't chase those quick wins. Don't follow the herd blindly. Be patient, disciplined, focus on what you can control.
And remember, investing is a journey, not a race. There will be bumps,
Oh, yeah.
but with a good foundation and a willingness to keep learning, you can handle those challenges and reach those goals.
And even more importantly, find that peace of mind. Feel confident in your choices.